Okay, welcome back everyone. We are still on the topic of NPV and IRR. Both are metrics used to help you value a property and see if it's worth the risk, really. And so we're going to do NPV in this video. And remember, NPV and IRR deal with cash flow, so cash outlay and then your cash income after you account for your expenses. So let's say our net operating income, so that's after we account for the revenue that's come in and the revenue or the money that's gone out for expenses, is a positive number. That's called your net operating income, and we'll talk about NOI, net operating income, a little bit later. But let's say that we have a hurdle. We have different options to place our money. So we could place our money in different investment vehicles, and we're looking at alternatives to a vehicle that may produce us 10% return. So we know that there's there's an investment that we're guaranteed 10% return. We want to see if a real estate investment will allow us to surpass that internal or that net present value, and so this is what we're going to do. First, we're going to figure out what our cash outlay is. We need to zero out our calculator. So Shift clear all. Okay, and we're going to say that our investment property is going to cost $600,000. Say the purchase price is $800,000, but we're putting down a $200,000 down payment, and we have well, you know, let's do this. Let's $800,000. Let's just do 850 like we did on the IRR. Okay, we hit negative. So just like what we did before. So cash flow 1, and we're going to say that this investment property is going to, we anticipate that we're going to be getting $90,000 a year. So cash flow 1, we're going to hit 10 shift NJ. So that's accounting for that yearly income for 10 years. And our hurdle rate, our discount rate, or the rate that we require of 10%, we're going to put there. So just 10 and interest. And remember, this is compounded annually. So what we're going to do is we're going to hit Shift, and then right here below the PRC is the NPV, so net present value, and we're going to hit that button, and we are negative $296,000, which means that for us, we would be in the hole $296,000, and this isn't a worthwhile investment for us. If you account for the outlay and the income over that 10 years. If we were to drop our interest rate, let's go like this. Let's take that 10%, let's take it in half. So we're going to do that, and then we're going to come back down to Shift NPV. You can see that the number dropped, but still at a 5% return, that $90-some odd thousand a year in income isn't really sufficient. It's not worth our money. So let's do this again, but let's say we have $850,000. Subtract, that's our cash flow. Oh, let's hit clear. My mistake. $850,000 negative cash flow 1. And let's say we bump our annual income from the property to $150,000. So 150. We're going to do that for 10 years too. So 10 shift NJ and that gives us the cash flows of 150,000 each year for 10 years. And let's say our hurdle rate, our discount rate that we're looking at is 10%. So we have to at least get a 10% return. Let's put that in the interest rate, what we did, and then we hit Shift, NPV, and we have a positive return. So yes, at $150,000 income a year with an $850,000 cash outlay, our value is positive. So any value positive or above 0 means that you will make money on the project, or it's worth your time. And here we see that it's 71,000. So I would say that this is a go.